For more on this, let's bring in Nathan Sheets. Nathan is Global Chief Economist over at Citi Research. So, Nathan, various talks taking place around the world, actually in the U.S. with countries from around the world. We do know that there's likely to be some kind of baseline tariff because that's what President Trump has made clear he wants to hold on to, regardless of what individual deals he strikes with countries. How do you think through what that means at the end of the day for the U.S. economy, given that we don't know how each negotiation will play out?
My expectation is that there will be some deals, but that the administration will hold to a 10% minimum reciprocal tariff. And I don't think, and time will tell, but I don't think they're going to negotiate on the sectoral tariffs that are likely to be set at 25%. So the upshot of this is we're going to see, even in the best scenario, a double-digit increase in tariffs relative to the time when Donald Trump took office. And that's going to be a historically high tariff rate, roughly matching what we saw during the time of Trump-Hawley, or let's try that again. Maybe that's what it was, Trump-Hawley. Yeah, Smoot-Hawley in the 1930s.
So the other thing, of course, is the ECB cut interest rates for a seventh time today. It dropped the word restrictive when describing its monetary policy. Most economists expect another cut in June. Is the European Central Bank ahead of the curve or behind the curve in confronting what it calls expected headwinds?
Now, a fundamental observation is these tariffs have very different implications for the European economy than they do for the U.S. For the U.S., it's stagflationary, higher inflation, weaker growth. For Europe, it's an adverse demand shock, weaker growth, lower inflation. And what you're seeing is the ECB get ahead of the tariff shock. And then at the same time, going into this shock, the European economy was softer, inflation was on a downward trajectory, and the ECB is responding. So I don't want to say one is ahead of the other. It's more that the economic situation and the set of challenges facing the economy is much different in Europe than it is in the United States, and more skewed toward economic weakness.
It's kind of interesting, too. I mean, we've heard from several Fed members who've basically said what you just said, and that's a part of the reason why they're saying, look, we're going to stand pat right now. Jay Powell seemed to ratify that, if not reiterate his previous comments at the Economic Club of Chicago the other day. Is there some sense that the Fed does have it right, that maybe patience at this moment in time is the actual virtue?
Well, that's very much my view, that, you know, the Fed has two objectives. One is low inflation, and the other one is job creation and solid growth. And the tariffs are working against both those objectives. So what do? Up front, you wait and see, and you assess which side of the mandate, which goal is more in jeopardy. But being patient up front is absolutely the right strategy for Jay Powell. And I would further say, given where inflation is, for him to be underscoring that he's going to fight inflation is the right policy. And maybe what that does is it helps anchor inflation expectations. And if inflation expectations stay where they are, then he's going to be able to cut sooner. It may allow him to get to a cutting trajectory more rapidly.
Okay, well, that's assuming he's around, because as you may have heard, that the President of the United States doesn't necessarily agree with some of the policy, I guess, decisions or lack of decisions, if you will. President Trump, earlier today, social media posts basically saying the Fed should be cutting rates. Powell is too late. He was asked about it at the White House earlier today when he was meeting with Giorgia Meloni. He said Jay Powell is terrible. And now there's a Wall Street Journal article that seems to suggest, citing unidentified sources, that for weeks they've been trying to lay the groundwork for removing Powell before his term ends. What would that do, or what message would that send to the markets if he were removed before his May 2026 departure date?
Central bank independence is absolutely an anchor for the economy and for the financial markets. And if we were to see the administration, in one way or another, take a meaningful step to compromise that independence or to violate that independence, I think would be in a place where the market volatility that we've seen over the past month or so would merely be the first course to a much, much larger and more challenging kind of downturn. There is a risk as we pursue policy after policy that's been previously uncontemplated, and we have it with the tariffs. If we now cross the Rubicon on central bank independence as well, that we start seriously and permanently undermining confidence in the economy and the markets.
Another form of undermining central bank independence is if perhaps Jay Powell or at the Fed or whoever else at the Fed does submit to what the president wants and cuts interest rates. And the goal from the administration is to see lower rates. Is that what they would get if the Fed were to cut rates right now?
Candidly, I think the answer to that is no, that there is at the moment real inflation risk associated with these tariffs. And if Jay Powell just stood up and said, I'm going to cut rates, I think the markets would say inflation's going up, inflation risk is going up, and you'd see a marked increase in the 10-year Treasury yield. It would push the curve in the opposite direction of the way that Secretary Bassett, President Trump, and the administration would like.
Do you have faith, though, that Jay Powell will sort of stay the course, that he takes this idea of independence so seriously that no matter how much pressure Trump puts on him, he'll stay the course?
Categorically. I think that Powell he's made several things clear, but if there's one in particular, it's that he is committed to using the tools of monetary policy to the best of his ability. And the Fed over the last 5 years has made some mistakes, but to the best of his ability to use the tools he has to achieve the full dual mandate, which Congress has given him.
All right, Nathan. Well, it's a sobering thought to think that this could even happen. In fact, we're having this conversation, but I love your wisdom and your relative optimism here as far as maintaining that independence. Nathan Sheets, Global Chief Economist over at Citi Research.